So you want to know how to read financial statements? Let me give it to you straight. Every CEO wants you to think the company is crushing it. But the truth, the real truth, it's buried in the paperwork, the income statement, the balance sheet, the cash flow statement. Most people glaze over that stuff. And that's exactly how companies get away with murder. Let's start with the income statement, the one they always brag about. Revenue, net income, EPS. Those big numbers at the top, they're just bait. The trick is what happens in between. A company can report $10 billion in revenue and still be flat broke. Why? Because they cooked the expenses, they delayed recognizing losses, or they added one-time charges to make their profit margin look cleaner. They'll say, we lost $400 million, but that was just restructuring. Right, and I'm a virgin. Look for patterns. If they keep using one-time charges every single quarter, that's not a one-time thing. That's a cover-up. Now the balance sheet, this is where the real skeletons live. Assets, liabilities, and equity. They'll try to impress you with total assets. We have $200 billion in assets. Cool story. But what kind of assets? If half that is goodwill, that's fake money. It means they overpaid for acquisitions and now it's sitting there like monopoly cash. Check the current ratio. Current assets divided by current liabilities. If it's under 1, they can't pay their bills on time. They're basically maxed out. You'll also see tricks like off-balance sheet liabilities. That's code for we owe money, but we don't want you to know. Now the cash flow statement, this is the one they hope you never look at. Because profits are easy to fake. Cash flow, not so much. You want to know if a company is real? Go straight to cash flow from operations. Is it positive? That's a good start. Negative? That's a red flag. They're burning cash just to stay alive. Then check cash flow from investing. Are they buying new equipment, expanding operations? Good. Or are they constantly selling off assets just to survive? That's not growth, that's liquidation. Now the final dagger, cash flow from financing. If they're borrowing like crazy, printing shares, or raising debt every quarter, they're not building, they're bleeding. Let me give you a real-world example. WeWork. They had flashy revenue on the income statement, billions. But go to their cash flow, it was a goddamn disaster. Negative operating cash flow every single year. They were surviving on hype and SoftBank's checkbook. Not a business, a financial hallucination. Or take Enron, legendary scam. They used off-balance sheet vehicles to hide debt and inflate earnings. They created fake companies just to keep their liabilities off the books. The average investor never caught it because no one taught them how to read the damn statements. And that's why this matters. Every line item has a story. Every ratio is a red flag or a green light if you know how to read it. You don't just invest, you invest with an edge. So here's your quick cheat sheet. Gross margin tells you how efficient they are. Net income is only real if cash flow from ops confirms it. Debt to equity ratio shows how over-leveraged they are. Free cash flow, that's king. That's what the big dogs care about. And if you see crazy high receivables growing faster than revenue, they're booking sales they haven't been paid for. It's the oldest trick in the book. Bottom line, most people see financial statements as boring. But the truth is, they're a code book, a map of where the bodies are buried. Learn to read it, and you'll never fall for a CEO's sales pitch again. Forget the press release, forget the headlines. The numbers don't lie, but the people reporting them do. Now go sharpen your edge. Want to know another red flag? Watch out for companies that constantly change their accounting methods. If you see terms like non-GAAP adjusted EBITDA or pro forma earnings, pay attention. That's like a magician telling you, don't look at this hand. They're redefining profit to fit their story. Theranos pulled that stunt on steroids. They didn't just mislead on revenue, they made up test results, then booked contracts off of fake science. And investors, they never questioned the paperwork. They were too hyped on the pitch. Same with WorldCom, they booked normal business expenses as capital investments. Translation? They told the world, we're building assets, when in reality they were just burning cash. That lie inflated their profits by billions, until it all collapsed. So if the numbers feel too smooth, perfect profits, no volatility, no hiccups, that's not genius. That's fraud dressed in a suit. Now here are 3 rules to protect yourself when reading financials. 1. If the business model doesn't make sense in plain English, don't invest. If you can't explain how the company makes money to a 12-year-old, they're hiding something. 2. Always check the footnotes. That's where the dirty laundry is. Debt covenants, legal settlements, revenue games, it's all there, if you look. 3. Compare year-over-year changes, not just the latest number. A strong company gets stronger. A weak company changes definitions. Remember, financial statements don't tell you the future, but they will expose the present if you know what to look for. Now you do.